Hey everyone, welcome back to our channel. Today we've got an exciting video lined up for you about assets and liabilities, so let's dive in. Financial literacy is a crucial skill in today's world, yet many people struggle to understand the core concepts that drive their financial decisions. One of the most important distinctions to grasp is the difference between assets and liabilities. These two terms, often referred to in personal finance and accounting, are fundamental to understanding how wealth is built and sustained. In this video, we will explore what assets and liabilities are, how they affect your financial health, and why understanding this distinction is vital for anyone looking to build a solid financial future. By the end, you'll have a clearer understanding of how to classify and manage your finances more effectively. What are assets? Assets are resources that have value and are expected to provide future economic benefits. In other words, assets are things you own that can generate income or appreciate in value over time. They are the building blocks of wealth and serve as the foundation for financial security. Assets can be tangible physical items or intangible non-physical items, and they can be categorized into various types depending on their nature and use. Let's explore some common categories of assets. Physical assets, tangible assets. These are assets that have a physical presence and can be touched or seen. Examples include real estate, properties such as homes, land, and commercial buildings. Real estate is often considered one of the most significant assets because it tends to appreciate over time and can generate rental income. Vehicles, cars, trucks, and other modes of transportation can be assets, especially if they are used to generate income. Equipment and machinery. These are essential for businesses that require tools or machinery for operations. For example, manufacturing equipment or construction machinery can be valuable assets. Precious metals and jewelry. Items like gold, silver, and valuable gemstones can be considered assets, as they often retain or increase their value over time. Financial assets. These are intangible assets that represent a claim to future income or a form of ownership. Stocks. Owning shares in a company entitles you to a portion of that company's profits, either through dividends or an increase in the stock's price. Or bonds. Bonds are essentially loans you give to governments or corporations. In return, you receive interest payments over time and the return of your principal when the bond matures. Mutual funds and ETFs. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets like stocks and bonds. Savings accounts. Although they offer lower returns, savings accounts are considered assets because they hold cash that can be accessed and used in the future. Business ownership. If you own a business, whether it's a small startup or a large corporation, that business can be an asset. Businesses generate income, create value, and can be sold for a profit in the future. Ownership of a business is considered one of the most powerful assets due to its potential for generating continuous income. Intellectual property. This category includes intangible assets like patents, trademarks, copyrights, and proprietary software. Intellectual property represents ownership of ideas, inventions, and creative works that can generate income through licensing, royalties, or selling. Human capital. While not always discussed in the same breath as physical or financial assets, your skills, education, and experience are valuable assets. They can help you generate income over your lifetime and contribute to your financial stability. Why are assets important? Assets are essential for building wealth and financial security. They work for you by generating income, appreciating in value, or providing other economic benefits over time. Here are some key reasons why assets are crucial. Assets like rental properties, stocks, and businesses can generate passive income, allowing you to earn money without directly working for it. As assets appreciate in value over time, your net worth increases. For example, if the value of your home rises, so does your equity in that property. Having a diverse portfolio of assets can provide a safety net in times of financial hardship. For instance, you can sell assets or use them as collateral for loans during emergencies. Assets, such as retirement accounts, investments, and property provide the financial foundation for a secure retirement. They ensure that you have the resources needed to sustain your lifestyle once you stop working. What are liabilities? Liabilities, on the other hand, are financial obligations or debts that you owe to others. Liabilities represent money that you need to pay in the future, either through regular payments or as a lump sum. In contrast to assets, liabilities reduce your wealth because they require you to use your income or assets to settle them. Liabilities can also be categorized into different types, depending on their nature and purpose. Short-term liabilities. These are obligations that are due within a short period, typically within a year. Examples include credit card debt. Balances owed on credit cards are considered short-term liabilities. Credit card debt can accumulate quickly due to high interest rates, making it a significant financial burden if not managed properly. Utility bills. Monthly bills for electricity, water, gas, and other services are short-term liabilities that need to be paid regularly to avoid service interruptions. Personal loans. Loans taken out for personal expenses, such as medical bills or vacations, fall under short-term liabilities if they are expected to be repaid within a year. Taxes owed. If you owe money to the government in the form of income taxes, property taxes, or other types of taxes, these are short-term liabilities that must be paid by the due date. Long-term liabilities. These are debts that are due over a longer period, often extending beyond 1 year. Mortgages. Home loans are typically long-term liabilities, often spanning 15 to 30 years. While a mortgage enables home ownership, it is still a liability that requires regular payments until the debt is fully repaid. Student loans. Education loans used to pay for college or graduate school are long-term liabilities. They often come with extended repayment plans that can last several years, depending on the loan amount and terms. Car loans. Loans taken out to purchase vehicles are long-term liabilities, usually with repayment terms of 3 to 7 years. Business loans. If you've taken out a loan to fund your business, it is a long-term liability. These loans may have repayment schedules that span several years, depending on the agreement with the lender. Why are liabilities important? While liabilities are often seen in a negative light because they represent debt, they play an essential role in financial management. Here's why liabilities are important. Taking on liabilities like a mortgage or business loan allows individuals and businesses to acquire valuable assets that they otherwise wouldn't be able to afford up front. For example, taking out a mortgage allows you to buy a home, which can appreciate in value over time and become a significant asset. Responsibly managing liabilities, such as paying off credit card balances or loans on time, helps build and maintain good credit. A strong credit score can open doors to better financial opportunities, such as lower interest rates and access to larger loans. Liabilities provide the ability to make major purchases that can improve your quality of life or enhance business operations. For instance, a car loan enables you to buy a vehicle for transportation, while a business loan helps fund expansion or new equipment. Balancing assets and liabilities. The goal of good financial management is to accumulate more assets while minimizing liabilities. However, it's important to recognize that some liabilities, like mortgages or business loans, can be beneficial when they are used strategically to acquire assets that will grow in value over time. Here are some tips for balancing assets and liabilities. Focus on accumulating assets that generate income or appreciate in value. Investments, real estate, and business ownership are examples of assets that can enhance your financial position. Not all debt is bad. Leverage debt strategically to acquire assets, but be mindful of taking on too much. High-interest consumer debt, such as credit card balances, should be minimized and paid off as quickly as possible. Keep track of your assets and liabilities and regularly calculate your net worth. This will help you monitor your financial progress and make informed decisions about spending, saving, and investing. Develop a comprehensive financial plan that outlines your goals for accumulating assets and reducing liabilities. This plan should include a budget, savings strategy, investment plan, and debt repayment schedule. Understanding the difference between assets and liabilities is essential for anyone looking to improve their financial situation and build wealth. Assets are the resources that generate income and appreciate in value, while liabilities are obligations that require future payments. By focusing on accumulating assets and managing liabilities responsibly, you can improve your net worth, achieve financial security, and work toward your long-term financial goals. Remember, building wealth is a journey, and the key to success lies in understanding the role that assets and liabilities play in shaping your financial future.